Thanks for clicking! The mortgage renewal wave will strain some Canadians, but most will manage. This according to a new report coming from TDBank. Yeah, and this isn't the first time that we've heard that the mortgage renewal wave is nothing to worry about. With TD playing it down last year, stories reporting that it could just be a modest headwind, and the Financial Post telling us that reports of a cliff have been greatly exaggerated. Most recently, as per the TD report, the Post's headline told us that Canadians could save $1,500 per month on their renewal payment.
Did I do good?
Yeah, but when we see listings going like this, people are choosing to sell their homes in a horrible market, combined with what I've seen on the ground and in conjunction with the Financial Post going all in, those are usually decent indicators that the TD report is worthy of closer inspection.
Why?
So what I want to do today is go over the TD report and why they say mortgage payments are coming down, take a look at their reasoning, or lack thereof, and then discuss some implications. We do have a big couple of weeks coming up with Stats Canada set to release Canada's inflation data on Tuesday, and the Bank of Canada set to make its policy rate announcement in a few weeks, along with a press conference held thereafter. And we'll obviously have an update out on both on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into TD's report. Onto the TD report, of which I would call a stunning display of the Dunning-Kruger effect. That is, where people with little knowledge of specific areas mistakenly believe they possess a high level of competency. TD notes that although the media may be raising the alarm bells over the apparent renewal, quote, shock, aggregate mortgage payments are actually coming down.
Don't you feel ridiculous now?
Now, if you're wondering what an aggregate mortgage payment is, you are probably not the only one, as it's not really a widely used term outside of TD. Those are all links to TD reports on the front page of Google. As mentioned, it's not really a widely used term. What TD is doing in its aggregate mortgage payment calculations is taking the sum of all of the mortgage payments across the system and saying that those are coming down. So if you took a 2-year fixed with RBC in June of 2023 at say 6.24 and now you're renewing at 5.49, your mortgage payment is coming down and you're contributing to the aggregate lowering of mortgage payments. So TD is looking at all of those mortgages, combining with all of those that are renewing from 2% mortgages and those that had variable rates back then, and saying that those payments in the aggregate are on the way down. Which I don't think anybody was ever really worried about those who took out mortgages in 2023 and 2024 at ultra high rates. That's just completely missing the point. Missing the alarm bells or the shock upon which the media was reporting.
Don't you feel ridiculous now?
The worry over the renewal wave was for either A, those who took variable rate mortgages with fixed payments, those 60, 70, 90-year amortizations, of which TD had many, or those who took a 5-year fixed between 2020, 2021, and early 2022. Those that are coming up for renewal in 25, 26, and early 27. Do you ever talk to someone of relatively lower sophistication and they didn't really understand the point, so they tried to re-explain themselves to you slowly, and you just kind of smile and nod along just to be polite? Or what the real estate industry calls a conference? Well, that's what TD's doing right now.
You just don't get it, do you?
But what this does allow TD to do is run a not dishonest study saying that in the aggregate mortgage payments are coming down, which then gets turned over to the media that run headlines like this. The mortgage wave is close to cresting. Some payments are coming down a whopping $1,500 a month. And then would-be buyers that are waiting for the renewal wave to happen think maybe it won't, don't delve into the data, and jump back into the market.
Our hands on deck.
But in contrast to this hypothetical scenario of someone that took $1 million mortgage out 1 year ago, let's take a look at what we're actually talking about. Someone that took out a mortgage back in 2021. Let's take someone that purchased the benchmark price home in Toronto in January of 2026, paying $928,000, put 20% down using an average interest rate of 2.02%. That person was paying $31.50 per month and had $621,000 due at the end of the term. Fast forward to now, that person now has a 20-year amortization, TD special rate of 4.59, and that person is now paying $39.50, an $800 increase or 22.5%.
Yep, nothing to get excited about.
Granted, you can always extend that amortization up to 30 years if you qualify, but man, are you ever going to pay for it, as over the next 5 years you'll devote $135,000 towards interest and $50,000 towards principal. And that's just for those who took fixed rate mortgages. Those who took variable rate mortgages, especially those with fixed payments, again of which TD had many, they've paid down a lot less principal. And many people did that in 2021 as rates were rising. So there's a big difference between renewing from 2020, 2021 and renewing from a year ago. And TD very well knows this, though that's never the point that hits the headlines. TD does admit within the body of the report that of those renewing in 2026, 40% are set to renew at higher rates. And yeah, we've tracked this before, about a year ago, almost to the day, when we found that the renewal wave gets worse and worse starting in 2025, and then payment increases peak around January, February of 2026. But, says TD, we shouldn't be overly worried about this renewal wave as there are 3 options available for those having to renew into higher rates. First, prices are up 25% since 2020, meaning you can always take out more equity. If you can't afford the payments on the debt that you already took out, you can always borrow more money to make those payments more manageable.
It's math. It's really not.
Which might work for some, but the key part is you can only refinance up to 80% of the value of your home. You can only take out 80% of the home's value. And for anyone that bought in, say, Toronto after March of 2021, that home is no longer worth what they paid for it. So yeah, maybe for some of the early purchasers, it might be possible to take out some equity to help manage the debt. But if you took out, say, a variable rate mortgage and haven't paid down much equity, or you didn't have a big down payment, then that equity takeout could be a rough ride. Second, TD says that borrowers could be well apt to deal with these higher payments as asset prices are up about 42%. Which is definitely true. The S&P 500, the TSX, etc., are definitely up substantially since 2021. With that said, although I don't have any research on this, and judging from its lack of footnotes, neither does TD, I'm not sure that it's the mortgage holders with vast stock holdings that were going to be the ones that would have a problem with higher renewal rates. It's more going to be the ones that bought around December of 2021, having been told that higher rates wouldn't upend the housing market, that are going to find themselves having an issue. And third, TD notes that disposable income is up for those with a mortgage, having found an increase of 27% since 2020. Now, TD doesn't cite its source that the rise in income was particular to mortgage borrowers, but we can see on StatsCan that debt to disposable income has been improving in Canada, but still much, much higher than historical averages. This rise in income for some households will no doubt make those rising payments more manageable, though that does not take into consideration any increases in debt that's happened since the purchase of those homes, nor does it take into account the rising cost of living.
Well, there's no way to determine that, Sam.
Yes, there is.
So, are payments better than they were a year ago? Yes. Is there still a reason to be worried about the mortgage renewal wave? Yes. None of that has changed. In fact, it continues to get worse. Mortgage rates are probably going to spike over the next few days following bond yields out of developments in the United States and in Canada. So what TD has done is come up with a measurement that includes outliers, massive outliers, which skew the aggregate data. Makes it seem like mortgage payments are coming down a lot more than they are. And then of course pushes it out to the media that do absolutely zero research and buys the TD data hook, line, and sinker. So what does all this mean? Well, month after month after month, over the past few months, we've been continually reporting increases in new listings coming to the market at much higher rates than they should be. Given that, as per the data that we've discussed on this channel, and TD even seems to be confirming, we're about halfway through the mortgage renewal wave, with it set to peak in January of 2026. Is this mortgage renewal wave the reason for these new listings? Well, we are hearing more and more reports of mortgage delinquencies. We're seeing more and more reports of powers of sale, and that is being confirmed by the data that was predicted 1 year ago. I'm not sure that the increase in new listings is due to the mortgage renewal wave, but the data does tend to support that argument. Whereas the data that TD gives us, not backed up by footnotes and regurgitated by the media, does tend to skew it. With that said, how this all plays out remains to be seen, but we will obviously continue to track how this all materializes on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.